Hi, so today we're going to be talking about debt and specifically debt covenants and how that affects investment decisions within real estate. Previously we've talked about balance sheet forecasting and really how that emphasizes the impact of the value of the asset going up and down and how that affects people's decisions, specifically how it affects the metrics of income returns and capital returns. So debt similarly has similar metrics that help measure the health of the debt against a specific real estate asset. So debt, we'll just quickly do some summary information on debt. Most of us, again, through having houses and understanding the concept of a mortgage, with any building, it's effectively the same concept. So very rarely today are organizations going out and buying properties with equity alone, meaning the money that they have in the bank. They'll typically get some kind of financing from some sort of financial institution, banks, or other vehicles for helping fund the transaction. And it makes a lot of financial sense to do that because it optimizes their deployment of capital. That's for another time. So from a debt perspective, if you look at it that a bank is investing alongside other organizations in buying a property, the debt that they're putting into this investment is potentially at risk for them. So the financial institution, namely the bank, is really going to want to understand how secure is their money, meaning how likely is it that they're going to get their money back. They're taking some risk in lending them the money, much the same as when we're buying a house and we'll get a mortgage from a bank. The bank will do some sort of credit check on us to understand, is this a safe investment for them or not? And then they have certain constraints. They have constraints like, I'm not going to lend you more than 50%, for instance, of the value of the property. And the reason that they do that is because they know that property values go up and down, and they always want to know that worst case scenario, if you cannot pay back this mortgage, I want to be able to take that asset back, I'm going to sell it, and then I'll get my money back. So there's different ways that financial institutions can manage and mitigate their risk as it relates to them supporting an investment. So we're going to look at specifically from a debt perspective and financial institutions that are going to be investing alongside organizations as to what are the metrics they look at. And so primarily we're going to focus on three. There are lots more, like in any organization, there's many more metrics, but the common ones that relate to debt are what we call the LTV. So this is the loan to value ratio. There's the interest coverage ratio. And then we have the DSCR, which is the debt service coverage ratio. So if we go back to the earlier principles we've discussed as it relates to a property, we always have to remind ourselves that we're in real estate, and real estate starts with the building, and the building generates revenue. It has expenses, which revenue minus expenses, we'll stick with simple terminology, the net operating income, which is the difference between our revenue, our operating revenue minus our operating expenses. And then we recently, in discussing the balance sheet forecasting, we highlighted the importance of the value of the asset. So there's the value that you buy this asset and how it appreciates over time. Now, as a person lending money on this, lending money to an investor in real estate, I'll draw a simple financial statement and balance sheet where, if we have revenue, for example, that let's say, NOI, say, that's looking like $10 a month into the future. Not a great investment. We'd want our NOI to be going up, but for the purpose of this illustration, that's fine. If we then have debt that we're looking at getting, so we're looking at buying this property, it could be a property that's worth $100 million, and we're looking at getting $50 million and putting in $50 million ourselves. So that $50 million is going to be broken up into two components. Again, it's very easy to relate to debt because you can relate to things that we know within our own mortgages on our houses. And we know that mortgages ourselves have two components to them. There's the principal. So the principal is the initial amount that you're borrowing. So in this case, let's say we're borrowing $50, just a simple example. Then there's the interest that you could be paying back, and let's say that's $5 a month. So there can be very, very complex and sophisticated amortization schedules. Amortization schedules are different combinations of how you pay this back over time. Generally, when you take out a mortgage today for a house, the bank is going to talk to you about your amortization term. So they'll probably say, do you want to amortize this over 20 years or 25 years, or in some cases 30 years? What that effectively means is, how long do you want to take to pay back this principal component? If you're paying it back over 20 years, then it's effectively, you're going to say, 50 divided by 20, and you'll figure out how much you're paying back each month, just a little bit of this each month, so that at the end of the term, you've paid back that full $50. Now, the other piece that we need to factor in is the interest, knowing that interest is charged or accrued on the money. So in the early days of the mortgage, if we were getting 10% interest, for example, on this, we're going to be accumulating $5, which is going to add to the balance of what's outstanding that you have to pay back, because the money costs money to these guys to lend it to you, so they need to get some return on that. So their return is the interest. And so that interest is actually accruing every month. So as long as you have an outstanding balance, the interest is being charged on that balance. So in theory, over time, so if you have a over time graph where your principal will look something like this, where it's reducing over time, then your interest, which would be accruing, you'd have a lot of interest accruing at this point, and it's go down to have nothing there. So the mechanics of how your interest is going to accrue. So again, why this is important is just really I'm trying to illustrate the two components, the principal component and the interest component. Now, the banks and financial institutions come up with very sophisticated ways of billing companies or charging companies for the repayment of this. So they could say things like, okay, we're not going to take any principal payments right until the end. So that's called a bullet loan. And basically what they say is you only have to pay the interest for the entire term. After 20 years, when this loan comes due, really it's going to be something more like 5 years in commercial real estate. But at the end of that term, then you have to pay the full principal back. So if you borrow $50 million, we're not going to have you pay any of that back. You just have to pay the interest for 5 years, and at the end of the 5 years, you pay us back the full $50 million. So that's called a bullet loan, or sometimes an interest-only loan. Now you have various combinations of how much debt and interest mix you're paying back. Back to our home example, the banks really work out a blend of each month you're paying back a certain amount of interest as well as a certain amount of principal, such that at the end of the 20-year term, you've paid back the whole mortgage, which has been the full principal balance as well as the interest component. So those are sort of the basic mechanics of how debt is going to be structured. And what these metrics, coming back to the metrics and the ratios that we talked about in the beginning, the loan-to-value ratio, the interest coverage ratio, and the debt service coverage ratio, they effectively give us measures for understanding the health and the security of this loan against the property. And I'll explain briefly how each one of them works. The loan-to-value ratio is really the simplest one to start with. It is represented by the loan amount, which is the balance. If we say this is, let's say, a $50 million loan, and the property that we're buying is $100 million, the loan-to-value ratio is really simply your principal amount over the value of the property, and it's going to give you a ratio, in this case, 50%. And so each organization is going to have certain covenants and restrictions as to how much they'll lend you. The rationale being, if, like in the GFC, where this property value dropped by 50% and it went from 100 million down to 50 million, they at least know that they can reclaim that asset, they can sell it, and then they can get their money back. So it's a comfort perspective to say, okay, we know worst case scenario, if you're not paying back your interest and your principal, we can take ownership of that property, sell it, and get our money back. Now, the thing with these ratios is it's at a point in time when they're lending you the building, when you're buying the building, there's a value for what that building was bought at. But as we know, the value of the building goes up and down over time. And so this ratio is going to change over time. And in the case of the global financial crisis, where property values really dropped substantially, the loan to value ratio went up substantially, and in many cases it breached the covenants. The covenants meaning the bank had a requirement and they said, we're lending you this amount of money, but you cannot borrow more than 50% of the worth of the building. Again, because they have in their metrics that they track, they have a confidence ratio and a risk tolerance that they're willing to lend you money with the understanding that the building's worth a certain amount. As soon as that building value drops down, then their ratio goes out, then they're very exposed, and that can breach the covenant, which means the bank can actually claim back their money. They can force you to pay back this, and whatever contract you had with them at the outset, they can say, contract terminated, just give us back our money now. And that actually happened in the global financial crisis. There were many organizations that they were in breach of their covenant for this reason exactly, and they could be forced to pay back the money right there and then, and that could and did actually bankrupt many organizations and individuals in certain cases. So that's effectively the loan-to-value ratio is giving you a comfort level and a ratio of testing the value of your building over the amount of the mortgage. The interest coverage ratio, so what that's telling us is simply the interest component, so this piece, over our NOI, or our EBIT is another way of looking at it. So there's the interest, monthly interest, over our NOI. So what that's doing is saying, on a monthly basis, you're earning, simple example, $10 a month on this property. Your interest is $5 a month, so 10 minus 5 is 5. So there's money left at the end of that after you pay back your interest. I'm fairly secure that the money I'm lending you, you're going to be able to pay the interest on an ongoing basis. But again, that could change based on the performance of the property and various other factors, and it's a ratio that banks will want to establish and say, we want to make sure that the health of this property and what it's generating on a monthly basis is generating enough NOI to be able to cover the interest. And how they determine that is through this interest coverage ratio. And they will establish covenants, and they will put it in the contract to say that if ever this ratio goes below a certain amount, again, they can break the contract, they can call in the debt. And so it's clearly another health metric which says what's the company's ability to be able to service their interest piece of their payment. The third ratio is the debt service coverage ratio. So similarly related, but it's introducing some other components. The other component that this is introducing is where we're not dealing just with the interest. We're dealing with the interest plus the principal. And that's, again, over the NOI. So now in this case, if we're amortizing this principal payment over 20 years and we're paying little pieces each month of this 50 back, we're taking that amount, we're adding it to our interest amount and saying, monthly we have to pay very much again like our mortgages that we're paying. And the mortgages we're paying on a monthly basis, that has a principal component and it has an interest component. And so what this ratio then does is say, how healthy is the performance of this property and the cash flow that it's kicking off to be able to pay back the principal and the interest. So it's related to the interest, but it's bringing in the principal repayment component, and it's another metric that the banks similarly could put in place and put covenants around and monitor the health of their interest in this property and how secure they are with their money. And so, as you can see with debt, and why Cougar is getting a lot of interest around our debt module is because clearly through this and clearly through the forecasting and the forecasting of a balance sheet, the importance of understanding your exposure to debt, both from people who are taking out the debt, because if they're putting a position where they're breaching covenants, knowing that the bank could actually force them to pay back, that's risk on the company. If they're suddenly forced to have to pay back this $50 million, it could be a serious consequence for them. So they have to monitor, one, their covenant they have to test their covenants from a risk perspective. If they're in breach, they're going to have to pay this back, but also there could be other financial penalties associated with it. So they could be imposed with fines or other things that are part of this agreement if they breach that. So there's a strong component within organizations to understand their own covenants that they have in place with various lenders. And similarly, from a lender perspective, they want to test these covenants to see how secure they are with their money out there. So there's lots of different dimensions to debt, and people wanting to understand the health of the debt and any risk of the debt, and really how they do it is back to these ratios and some others that augment them. But these are the foundational ones: loan to value ratio, interest coverage, and debt service coverage ratio. Thank you.